Hey everybody, welcome back to Whiteboard Finance. So we're financing lunch now, okay? So in this video, I can't make this up, you guys. So DoorDash just announced a partnership with Klarna. So now you can finance your fast food. That's right. You can now go into debt for a burrito. So that may sound like a sort of a joke, but it's actually the symptom of something much bigger, and we'll get into that. My thoughts are that we're in a consumer debt bubble, and I'm going to walk you through exactly how we got here and what it means for you and your wallet and your investments. Let's get into it. Okay, so DoorDash partners with Klarna to offer U.S. customers even more convenience with flexible payments. Nice. More debt. So before we get into this very chart data heavy video, I got to get these memes out of the way, you guys. What do you mean you have $11,000 in DoorDash debt? Picture of Dave Ramsey. Excited to announce that I closed on a $31.38 transaction to secure a burrito and a side of chips. 20-year senior fixed rate financing was provided by Klarna. DoorDash provided delivery of the asset. DoorDash debt collection, Tony Soprano, Paulie Walnuts. And then this is a good one. So this is from The Big Short. So we take these DoorDash loans, combine them, and create a whole new instrument where investors can bet on whether borrowers will pay off their Taco Bell Crunchwrap Supreme within 12 months. All right, so let's get into this. This is too funny. So here's what happened. So DoorDash and Klarna are now offering 3 payment options for food delivery. Okay, so you have pay in full, okay, like a normal human being. You can pay in 4 interest-free installments. Not great, but okay, I guess. And then you have pay later, aka take on short-term debt for a cheeseburger, okay? So why is this a big deal? Because not just DoorDash, in 2024, Americans spent $75.1 billion using buy now, pay later services, okay? That's a record. So about 1 in 5 consumers used it in 2023. That's 19.9% of the country using debt to make everyday purchases. This isn't final innovation. This is survival mode, you guys. So let's rewind a bit. So let's take a look at total debt, and its composition. So over the past few years, consumers have been fighting inflation with debt. Okay, so from 2021 through 2023, inflation outpaced wage growth. So what did people do? They tapped into their savings, but that only works for so long, especially if you don't have a big emergency fund, okay? So according to the San Francisco Fed, over $2.1 trillion in excess savings has evaporated since 2021. So what's obviously the next step? It's to swipe that card, baby. So let's take a look at where we're at right now. So total household debt, as you can see by this chart, is $18.04 trillion, okay? That's the gray bar. And then credit card debt is $1.21 trillion. This is an all-time high. That's $3.9 trillion added in just the past 5 years. So our lizard brains can't even comprehend the difference between million, billion, and trillion. Fun fact, if you want to look that up, figure that out and how much time goes by in seconds. You can Google million seconds, billion seconds, trillion seconds. Let me know down in the comments below once you actually figure out that difference. It's pretty mind-boggling. So this is where it gets concerning. 10.8% of credit card users are only making minimum payments. This is the highest since 2012. 3.5% are already late. This is 30 days or more late. And then 11.1% of credit card balances are 90 days delinquent. Okay, you can see that from this chart right here. That's the highest since 2011. We didn't even hit those numbers during COVID lockdowns, okay? But it is spreading, and it's not just credit cards, okay? It's auto loans, it's mortgages. These are back at 2008 levels, as you can see by this chart right here. The source is Augur Infinity. So there's serious delinquencies rising at the fastest pace in 15 years. Mortgage delinquencies, as we mentioned here, you can see in the the yellow line, they are ticking up, but it's nowhere near where they were in 2005. Also, there's a lot of people talking about housing bubble and this and that. There's so much more, how do I say this, cash on the sidelines, and also the loan to values are much lower now than they were in 2008. So I'm not a big believer about the mortgage thing, but if you look at auto loans and credit card loans, these are undeniably ticking up, as you can see right here. If you look at the green line, that's credit card loans. If you look at blue, those are auto loans. Okay, so let's keep going. So in this chart, you can see wages and inflation. I wanted to back up that talking point from earlier. So you can see the blue line are wages, and it goes back to December of 2020, and it goes all the way to December of 2024. You can actually see they're basically in a downtrend since June, actually August of 2022. And then if you look at inflation, this black line, you can obviously see it spiking like crazy in June of 2022, where my cursor is, and then coming all the way down a year later to June of 2023. And then now it's still somewhat sticky. It's still way higher than 2%, which is the Fed's typical target. Now, if you look at this chart, this is the pandemic era excess savings. So you can see on the left-hand side over here on the y-axis, we have dollars in trillions. So the top is 2.5 trillion. The x-axis are years, 2020 to 2024. And then you can see the peak was basically August 2021. We had excess savings of 2.1 trillion. Now we fast forward to March of 24, it's negative 72 billion. But here's the real kicker, you guys. Consumers are feeling it, okay? Consumer confidence is plummeting. More people now believe business conditions are getting worse than at any point since 2008. We're 15 percentage points above that crisis. Take a look at this chart right here. So long-term inflation expectations just hit 3.9%. I talked about this in my last video. This is the highest since 1993, and one-year inflation expectations are up to 4.9%. And yet the Fed says it's transitory. I don't know. I don't know, you guys. I think they're between a rock and a hard place. If they raise rates, they risk recession. If they lower rates, they risk inflation. That's why we've been talking about stagflation a lot on this channel. So if you take a look at this chart, we're at a record high share of consumers think that business conditions are worsening. This is titled Expected Business Conditions in 1 Year. Worse is the percentage. So you can see here every gray bar is a recession that kind of spikes up. I mean, if you look at 2020, this is nothing compared to where we're at right now. So pretty interesting stuff. So if we look at the University of Michigan long-term inflation expectations, you can see that they surged to the highest since 1993, as I mentioned earlier. So what does this mean for you, and why does this matter? So this debt bubble, in my opinion, is unstable. Okay, you can see Americans they have payments on everything. Jet skis, cars, mortgages, groceries, fast food now. You know, it's the subject of this video. It's unstable, and instability creates volatility. If you look at the S&P 500, we're seeing $500 billion swings in the S&P 500 on a near daily basis. If you guys have been following the market for the past 2-3 months, go take a look at the chart of S&P 500. It's up and down, up and down. It's crazy. I've never seen anything like this. So for long-term investors, this is an opportunity, but it also means tolerating risk for a little bit. So what do you do? So in my opinion, focus on cash flow. Cash flow has always been king. Okay, it's what allows you to stay afloat. Build an emergency savings like we've been talking about on this channel for years, okay? My rule of thumb for emergency savings is anywhere from 3 to 6 months. 3 months if you're just a single guy with no dependents, okay? 6 months if you have maybe someone depending on you. And then 12 months, in my personal opinion, if you are someone with volatile salary, a business owner, commissioned salesperson, anything along those lines where you don't have predictable income, I go a year out, and some people think I'm crazy for that. But again, I'm 37. I saw the great financial crisis, COVID. I saw a million crises in my life. Okay, so I'm a little bit more risk averse. And then finally, stay diversified. So this is going to be a wild ride. So yeah, DoorDash is letting you finance your tacos. You know, that's kind of the funny part of the video. It sounds funny, but to me, it's just flashing a warning sign about where we're at financially. So let me know down in the comments below. What do you think about this? What do you think about never-ending payments, financing literally groceries? I get some people are struggling. I'm not trying to make light of that, but like, come on, you guys, what are we talking about here? So if you got value from this video, make sure to like, subscribe, and share it with 3 friends or with someone who needs a financial wake-up call. Again, thank you so much for watching. And as always, have a prosperous day. Okay, 27 bean burritos. Done. Nice. My wife's going to love me tonight.